You spot a home with a price so low it feels like a mistake. Before you get excited, ask, was this home built before 1976? That year is a hard line in real estate financing. If yes, your dream home could become a financial nightmare. Most banks won't touch it. I'm Kris McCullough, retired Marine and real estate lender, here to help you avoid costly mistakes. Today, we're exposing the hidden risks of pre-1976 mobile homes. These bargains often come with baggage lenders refuse to finance. It's the classic too good to be true scenario. Think of it like buying a car without checking under the hood. You need to know what you're getting. Before 1976, factory-built homes had no national standards or consistent safety regulations. That's why banks see them as risky gambles, not solid investments. I've seen buyers and agents get burned by these deals. Don't be one of them. Let's make sure you know how to spot these traps and focus on homes you can actually buy. There's a huge difference between a mobile home and a manufactured home, and it all hinges on 1976. Mobile homes, built before June 15, 1976. Manufactured homes, built after, under strict HUD standards. Lenders see that date as the line between a regulated asset and a risky unknown. Manufactured homes can qualify for VA, FHA, USDA, and conventional loans just like site-built houses. Pre-1976 mobile homes, lenders see them as depreciating assets like old cars. No HUD tags, outdated materials, and potential safety hazards make banks nervous. That's why most won't finance them. I've seen too many buyers get their hopes up, only to be disappointed. By the end of this video, you'll know why banks hesitate, what limited options exist, and how to find a home you can actually finance. Knowledge is power. Let's dive in. The most important date in this story, June 15, 1976. Before then, mobile homes were built with little to no federal oversight. Every state had different rules, some had none. Quality ranged wildly, some homes were solid, others dangerously flimsy. For buyers it was a gamble. For lenders it's still a mystery. Mobile home means June 15, 1976, unregulated, unpredictable, and risky. Many were built to be moved, not as permanent real estate. That's why banks treat them more like vehicles than homes. People often confuse the terms, but in finance, the distinction is everything. Calling a pre-1976 home a mobile home is a red flag for lenders. It signals unverified quality and unpredictable value. Banks want assets that are safe and stable. With pre-1976 mobile homes, there are no guarantees. That's why financing is nearly impossible. On June 15, 1976, HUD stepped in and changed everything. The National Manufactured Housing Construction and Safety Standards Act, known as the HUD Code, set strict, enforceable rules for factory-built homes. Now, every home had to meet national standards for structure, fire safety, plumbing, electrical, and energy efficiency. Each post-1976 home gets a HUD certification label, a red metal tag proving it meets these standards. This tag is your proof. The home is safe, regulated, and financeable. The industry renamed these homes manufactured homes to mark the difference. It's not just a new name, it's a legal and financial distinction. Manufactured homes are engineered, stable, and recognized by lenders. That's why banks offer VA, FHA, and conventional loans for them. The HUD code turned a risky product into a legitimate housing option. If you want a home you can finance, look for that HUD tag. So why the confusion? Old habits die hard. People still call all factory-built homes mobile homes, even brand new ones. But using the wrong term can cost you, especially with lenders. Say mobile home, and a loan officer might assume it's pre-1976 and shut you down. That's why you need to be precise. Always ask for the date of manufacture. Calling a manufactured home a mobile home is like calling a Tesla a horseless carriage. Same idea, different era. The old name carries the baggage of an unregulated past. Knowing the difference protects you and helps you ask the right questions. When you see a listing, your first question should be, what's the exact date of manufacture? This knowledge saves you time, money, and disappointment. Be a savvy buyer, know the difference, and avoid costly mistakes. When a bank lends money, they're making an investment, wanting to be sure they can get their money back. The house is their collateral. For a traditional home, that's usually a safe bet because homes tend to appreciate. But a pre-1976 mobile home, that's a depreciating asset. Banks view these older mobile homes more like a car. They were built to be personal property, and their value tends to go down. Lending money against a depreciating asset is risky. Banks are in the business of making money, not losing it. This depreciation is why they often deny these loans. The low price reflects its perceived value in the financial world. A lender sees a ticking clock of depreciation. Remember the HUD tag? Pre-1976 homes don't have them. It wasn't a requirement. This is a red flag for lenders. The tag verifies safety and construction standards. Older homes can also have VIN issues. The VIN plate can be damaged or removed. Without a clear title and matching serial number, lenders can't issue a loan. Underwriters need to check boxes and confirm facts. It's easier to deny the loan than navigate the uncertainty. Post-1976 homes fit the system with a HUD tag and clear serial number. Pre-1976 homes break the system. Without proof of compliance, there's no foundation for a loan. Let's talk about what's lurking inside the walls of homes built before 1976. Since there were no national standards, manufacturers could use whatever materials they wanted. This leads to construction risks that make lenders nervous. One concern is the framing. Many older mobile homes were built with wood frames, sometimes with lower-grade lumber, that are far more susceptible to rot and termite damage. Modern homes are typically built with steel frames which are stronger. Then there's the stuff you can't see, which is often the scariest part. The wiring and plumbing can be prone to issues, leading to mold and structural damage. Insulation is another major issue, leading to high utility bills. Ultimately, all these potential construction flaws add up to unpredictable and potentially massive repair costs. It's just asking for trouble. Let's say a bank breaks all its own rules and decides to give you a loan on a 1973 mobile home. Now fast forward a few years. You get a new job in another state and need to sell. You put the house on the market, find an eager buyer, and then they go to get a loan. What happens? They run into the exact same brick wall that you should have run into. No traditional lender will finance it for them either. This creates a massive resale headache. Your pool of potential buyers is instantly limited to people who can afford to pay in cash, which is a very, very small group. This resale difficulty is a huge factor for lenders. They have to think about the marketability of the property. If they ever have to foreclose on the home, how easily can they sell it to get their money back? With a pre-1976 mobile home, the answer is not easily at all. They would be stuck with an asset that almost no one can get a loan for. This makes it incredibly unattractive from a risk management perspective. They aren't just underwriting you, they're underwriting the future saleability of the home itself. A property that's nearly impossible to finance is a property they don't want on their books. On top of the resale problem, there's the insurance nightmare. Most mortgage lenders require you to have homeowners insurance for the life of the loan. It protects their investment in case of a fire, storm, or other disaster. But trying to get insurance on a pre-1976 mobile home can be incredibly difficult and expensive. Many major insurance carriers simply won't offer a policy for them, citing the same risks the banks do. Unknown construction, potential fire hazards from old wiring, and structural weaknesses. They see these homes as a high probability for a future claim. Even if you can find an insurer willing to cover a pre-1976 home, the premiums are often astronomical. You might pay 2 or 3 times what you would for a policy on a modern manufactured home. This high cost of insurance directly impacts your debt-to-income ratio, which is a key metric lenders use to approve loans. If your insurance payment is too high, it can push your total monthly housing cost over the lender's limit, disqualifying you for the loan. So even if a bank was willing to consider the loan, the insurance hurdle alone is often enough to kill the deal. Financing a pre-1976 mobile home isn't impossible, but it can get tricky. The main option is a chattel loan. This is not a mortgage secured by real estate. It's a loan for personal property, like a boat, RV, or mobile home, not considered part of the real estate. Think of it as a car loan. This is critical because it changes the financial equation. You don't get the same consumer protections or favorable terms as a traditional mortgage. It's often the only option for older pre-HUD code homes. Chattel loans are higher risk, offered by specialized finance companies, not banks. This often doesn't work out in your favor. It's the loan of last resort. Walk into it with your eyes wide open. Let's talk about chattel loans. Expect a hefty down payment. Lenders see older homes as risky. They want you invested so you won't walk away. Expect to put down a significant sum up front, typically at least 20%. That's $10,000 on a $50,000 home. This can be a major barrier for first-time buyers. If the down payment doesn't scare you, the interest rate might. Expect to pay a premium. Interest rates can easily climb into the double digits. Rates of 12, 15 or higher aren't uncommon. This impacts your monthly payment and the total cost. You could pay more in interest than for the home itself. So you've managed the down payment and stomached the high interest rate. The lender will then hit you with the loan term, the amount of time you have to pay it back. With a chattel loan for a pre-1976 mobile home, you can forget about a 30-year term. Lenders aren't willing to tie up money for decades on a depreciating asset. Loan terms are much shorter, maybe 10 to 20 years, or even 7 for older units. This creates a financial squeeze, a high interest rate combined with a short repayment window. Remember what kind of financing this isn't: VA, FHA, USDA, or conventional. There's no government guarantee backing the lender, which is why the terms are so harsh. You are operating outside the mainstream system, and that comes with risks. You're navigating a complex financial product without the safety net millions of homeowners rely on. You might be tempted to think the only sane way to buy one of these homes is with cash. On the surface, this seems like a brilliant move. No down payment, no interest rates, no loan terms to worry about. This can be a viable strategy, particularly if the home is in a park with low lot rent. The biggest issue is that you are tying up a large amount of your liquid capital in a depreciating asset. Had you put that same money into a different investment, it could have been growing for you. Furthermore, you still have to deal with the resale problem down the road. This severely limits your market to other cash buyers, which can make the home difficult to sell. So, is it ever a good idea? It can be, but only in very specific circumstances. But if you are thinking of it as an investment, you are almost certainly better off looking for a home that you can get a proper mortgage on. The cash option isn't a magic bullet, it's just a different set of trade-offs. We've discussed the pitfalls of buying pre-1976 mobile homes. Now let's focus on successful homeownership. The golden rule: exclusively search for homes built after June 15, 1976. These homes qualify for various financing programs: VA loans, FHA loans, USDA loans, and conventional loans. A modern HUD code manufactured home is the right tool. When searching online, ask for the exact date of manufacture. If it's before June 15, 1976, move on. This discipline is invaluable. So you found a manufactured home. The next critical step is to investigate what the home is sitting on. The foundation is everything. It generally must be permanently affixed to a foundation on land that you own. You need to ask if the home is on a certified permanent foundation. In many states, this is known as a foundation certification. You have to get down and dirty, or at least make sure someone does on your behalf. You should also ask the seller for a copy of the recorded foundation certification. If they can't produce it, that's a major red flag that needs to be investigated. It's the difference between a smooth closing and a deal that falls apart. It's a crucial piece of due diligence that protects you from wasting time and money. You've confirmed the home was built after 1976 and is on a permanent foundation. Locate the home's official identification tags, the HUD certification label, usually on the exterior rear wall. On a double wide, there's a tag on each section. Also, find the data plate, a paper document usually inside a cabinet door or near the electrical panel. Finding these is your final checkpoint for a smooth loan process. You've essentially pre-screened the property for your lender, answering big questions and showing you're a serious buyer. This proactive approach allows you to move forward confidently, knowing you can actually buy the home without surprises. So, let's bring it all home. We've been on quite a journey, from the wild west of pre-1976 mobile homes to the smart, regulated world of modern manufactured housing. The biggest takeaway I want you to leave with is this: cheap doesn't always mean good, and a bargain on paper can quickly become a financial disaster in reality. That crazy low price you see on an old mobile home isn't there because you've discovered a hidden gem. It's low for a reason. It's a reflection of the risk, the headaches, and the financing nightmares that come bundled with it. It's a warning sign, not a welcome mat. Remember, the enemy here isn't the fact that the home was built in a factory. Modern manufactured homes are incredible, high quality, and affordable housing options. The real enemy is the year it was built. That dividing line of June 15, 1976, is everything. It separates the unregulated relics of the past from the safe, durable, and financeable homes of the present. Your mission, should you choose to accept it, is to stay firmly on the modern side of that line. Don't let a low price tag tempt you into a battle with lenders that you are almost guaranteed to lose. Focus on the homes that set you up for success. The key is to be an educated buyer. You now know more about this topic than 99% of the population, and probably more than a few real estate agents out there. You know to ask the right questions, you know to check the build date, you know to verify the foundation, and you know to look for those all-important HUD tags. This knowledge is your shield. It protects you from wasting time, from getting your hopes up on a dead-end property, and from making a decision that could haunt your finances for years to come. You are no longer just a house hunter. You are a savvy real estate investigator. Think of this as your pre-flight checklist for buying a manufactured home. Date of manufacture? Check. Permanent foundation? Check. HUD tag and data plate? Check. When you can confidently tick all those boxes, you're cleared for takeoff. You can approach a lender with a property that fits their models, meets their requirements, and qualifies for the best loan programs available. You've done the homework, you've eliminated the risks, and you've put yourself in the driver's seat. That's how you buy a home the smart way, without the drama and without the regret. Ultimately, my goal is to empower you. Buying a home can feel overwhelming, especially when you're navigating a niche market like manufactured housing. There's a lot of misinformation and confusion out there, and it's easy to feel like you're in over your head, but you don't have to be. By understanding these fundamental rules, you take back control. You're not just reacting to what the market throws at you, you are proactively seeking out the properties that will be a blessing, not a curse. You can walk away from that steal of a deal with confidence, knowing you just dodged a bullet. That's where I come in. My job isn't just to get you a loan, it's to be your guide and your advocate through this entire process. I've helped countless buyers and real estate agents navigate the complexities of the manufactured home market, ensuring they find great homes with great financing. I'm here to give you the truth, even when it's not pretty, because I believe an educated buyer is an empowered buyer. You should never feel like you're alone in this journey. Having an expert in your corner who knows this stuff inside and out can make all the difference in the world. If this video helped you, please do me a huge favor. Hit that subscribe button, tap the notification bell so you don't miss future tips, and drop a comment below. I'd love to hear about your own experiences. Have you ever run into issues trying to finance a mobile or manufactured home? Your stories help other people learn too. And for more resources including loan calculators, free ebooks, and information on how I help clients get home loans all across the United States, you can find me over at KrisMcCullough.com. Thank you for watching. I'm Kris McCullough, retired Marine real estate loan specialist, and the guy who's committed to helping you achieve your home ownership goals the right way. Your dream home is out there, and now you have the knowledge to go out and find it with confidence. Don't settle for a financial headache just because it looks cheap. Go for the smart investment that will serve you and your family for years to come. I'll see you in the next video.